All right. Thank you for joining us today. The purpose of today's meeting is for you as investors to walk away from the seminar with a viable solution to what is often considered to be the retirement problem of owning investment real estate. We're going to start by walking through the concept of a 1031 tax-deferred exchange from the perspective of a qualified intermediary. And then we'll take about 20 minutes to introduce the Delaware Statutory Trust, which is a 1031 exchange qualifying vehicle that allows investors to transition from actively managed real estate ownership to passive real estate ownership. My name is Ryan Thomas. I am with JRW Investments. I'm a registered representative with the company. Our firm was founded in 2003 out of a CPA and financial planning practice, actually started by my father in the early 1980s. Our specialty is real estate and real estate syndications. We work with both cash investors and exchange investors. This is my 18th year in the industry. Currently, we underwrite about 200 different investments a year and typically recommend only about 5 to 10% of what we review. Today, we also have joining us as special guest Kelsey with Asset Preservation. Stephanie is the Southern California Division Manager, and she has committed the last decade of her career in real estate and specializing in 1031 exchanges in both the residential and commercial sectors, and that would include the Delaware Statutory Trust vehicle. Asset Preservation is a subsidiary of Stewart Information Services Corporation, which is a New York Stock Exchange publicly traded company. Stephanie and I have had the privilege of knowing one another for the last 8.5 years and worked together very regularly. So I'm excited to have her here today. And Stephanie, I'll let you introduce Asset Preservation how you'd like to, and we'll get started into the overview of the 1031 exchange.
Hi, Ryan. Hi, everybody who's joined us today. Thank you so much for having me here. I appreciate the opportunity to talk to you about the 1031 exchanges and what an important investment tool it is for anyone who owns real estate property or who's been involved in a DST. So I'm with Asset Preservation. Again, as Brian said, I'm the Southern California Division Manager. Asset Preservation has been around since 1990. We have performed and facilitated over 200,000 tax-deferred 1031 exchanges on behalf of our clients. And as he said, yes, we are associated with Stewart Information Services, and we're a good member in good standing with the Federation of Exchange Accommodators. So let's get into it. We're going to talk a little bit about the 1031 exchange. So what the 1031 exchange is, it's tax deferral on the sale of property used in a trade or business or held for investment when exchanged for like-kind property. We're going to talk also a little bit about capital gains taxes, exchange entities, and why that's such an important thing to know about. Like-kind property, what actually qualifies, what is the holding period, and we're going to also go over the identification rules. So first off, when you are an investor and you've got property, you have alternatives. You can hold your property and kind of decide if you want to see what the market does before you choose to sell. Should you choose to sell, you can decide to just sell that, pay the taxes that are owed on your capital gains, and possibly reinvest in a different vehicle that is not real estate related. Or you can choose to do a 1031 exchange, which allows you to defer all capital gains taxes with a fully deferred 1031 exchange, or receive some boot through a partially deferred exchange. Redeploy that equity that would have been used for capital gains taxes into the purchase of a larger replacement property or multiple replacement properties. Now, what are some reasons that investors might want to do a 1031 exchange? Maybe they have a high equity asset or something with that's completely paid off. They can use that equity as their down payment and then get with a lender to leverage into a larger property or expand their portfolio with multiple properties. Diversification, either by asset or by geography. Say they have a couple single family residences and they want to kind of diversify that asset a little bit, maybe buy some retail, commercial, multifamily. And geographically, if they've got everything in one place, maybe they want to spread it out to a couple different places, just to different states, different locations, just to diversify on geography. Consolidation, you might own multiple properties and the management is getting a little bit rough, so you decide you want to just consolidate into one larger asset. Cash flow, obviously, that's what the investor wants, is to increase their cash flow. Management relief, like I said, possibly for consolidation purposes. You could go into something like an apartment building and hire a manager, or do something like a DST where that's going to be basically passive income. And estate planning is a really important one. You're looking at all the assets you have and how you're going to deal with leaving those to your heirs. So either maybe multiple properties or go into something like a DST where you can kind of portion that out. So estate planning is a very important one for lots of our investors at this time. So what is a 1031 exchange? It's been around since 1921. One aspect of the tax code provides taxpayers who own real estate, who own real estate a significant tax advantage. So the 1031 allows a taxpayer holding real property for investment or business purposes to potentially defer all of those taxes that would otherwise be incurred upon the sale of that investment property. And I'm going to get into what those capital gains taxes are. So capital gains taxes. Basically, there's 4 components. First, we're going to have taxation on the depreciation recapture. That's at 25%. Next, there's going to be the federal capital gains taxes, 15 to 20%. Then there's the 3.8%. That one's a net investment income tax. And then California's tax has now increased from 13.3 up to 14.4. So you can see that's going to be a significant hit if you're going to not do a 1031 exchange and choose to pay those capital gains taxes. So here's a scenario where you get to see kind of what that would look like. So assume a married couple is filing jointly. They have a property in California. They're going to sell it for $1 million. The couple originally purchased the property for $400,000. 75% of that property is depreciable, and the property has been fully depreciated over 27 and a half years for residential. The capital gains is now going to be $900,000. That's with the adjusted base of $100,000. Again, there's 4 levels. The depreciation recapture at 25%, federal gains at 15 to 20, net investment income tax at 3.8%, and then state taxes at 14.4. So what will that look like if they choose to pay their taxes? So they've got their property at $1 million. Okay, then we've got the 300,000 of that is going to be depreciated at 25%. The remainder of that is going to be subject to capital gains taxes of 20%, 120,000. 900,000 at 3.8 is 34.2 or 34,200. And then 900,000, we're just using 13.3, which is about just under $120,000. So you see the tax hit right there is $348,000 that's going to be going to the IRS, where you're only going to have $651,000 left over to reinvest and, increase your return on investment. Now, if you choose to do the 1031 exchange, you can defer those capital gains taxes and redeploy the equity that's left over from that sale, as well as any debt. So it would be $1 million minus closing costs and commissions. So what does the 1031 exchange code actually say? No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such property is exchanged solely for real property of like kind, which is to be held for either productive use in a trade or business or for investment. So basically that just means if you've got this investment property, you can do a 1031 exchange as long as you're going to be purchasing another investment property. Exchange entities. These are very important. So the main thing with the exchange entity is we want to find out who the actual taxpayer is. Because again, the 1031 exchange is a tax code for the taxpayer. So here's some examples. If the wife is relinquishing the property, then the wife is acquiring the property. If an LLC is relinquishing the property, then the LLC would be acquiring the property. Same with the corporation and the partnership. Again, one thing we want to make sure is we understand who the tax owner is. So if you're unsure, always check with your CPA to make sure, because say you have an LLC and the LLC is strictly there for liability purposes, but ultimately you're the taxpayer on that property. We want to make sure we know that because, again, tax code is for the taxpayer. So what kind of properties qualify for a 1031 exchange? Like-kind property is often misconstrued. People think if they have a single family, they have to buy another single family. That is incorrect. Basically, like-kind properties, everything you see here can be exchanged for everything you see here. So which properties are excluded? So your primary or principal residence is not allowable for a 1031 exchange. Property held for dealer purposes, like flips. You purchase a property, you fix it up, you sell it. That does not qualify for a 1031 exchange. The IRS sees that as inventory. 1031 exchange is for investment property that's being held for productive use, again, in a trade business or for investment. So any relinquished property held for productive use qualifies for a 1031 exchange as like-kind property. So can raw land, commercial, single family, multifamily, office, industrial, easement, air rights, water rights, vacation homes held for investment, and DSTs, those are all considered to be like-kind property under the 1031 exchange. Is there a holding period? Technically, there is no holding period, but you want to be able to show intent that when you purchased the investment property, your intent was to purchase it for a long-term investment. So there are a couple ways to look at that. One perspective, there is a private letter ruling from the IRS indicating that if you've had your property for 24 months or more, that's pretty much sufficient to them to feel that that counts as a long-term investment. If you need to sell earlier, we do recommend, with obviously talking with your CPA first, having it for 12 months and then straddling a tax year. Again, there is no actual hold period. So circumstances change. I had a client recently, he purchased a property for $350,000. He was planning on building on it and then having those as rental properties. He hired a real estate agent to get him rent comps for the area. He was talking to builders, working out plans. 8 months later, somebody came to him and offered him $850,000. He felt that that was a good deal and he decided to sell and do a 1031 exchange. He and his CPA both felt that they had enough of a paper trail to show that his intent was to purchase the property for long-term investment purposes. So let's talk a little bit about an exchange equation. Basically, for full tax deferral, a taxpayer must meet two requirements. The first one is to reinvest all their net proceeds. And the second one is to acquire a property with the same or greater debt for full tax deferral. So we're going to show you what that looks like here. You've got your property. You sell it for $900,000. You have $300,000 debt. The cost of the sale, meaning closing costs and commissions, $60,000. So the remaining net equity there is $540,000. So as you see, if you go across the bottom, they have reinvested that $540,000, which has caused no boot. Boot is subject to capital gains taxes. That's any cash that's not reinvested. They have increased their debt up to $660,000. And again, there's no boot there because they reinvested or required debt that was greater than what they had. So again, no boot, mortgage boot. And then the value of their new property is $1.2 million. Now, should you choose to do a partial exchange, you can. You do not have to reinvest all of the funds, and you do also not have to take on the same amount of debt. However, anything that you do not reinvest will be subject to capital gains taxes. So here we have $900,000 value, $300,000 debt, $60,000 for cost of sale, and net equity at $540,000. You see this couple or this person decided to only reinvest $440,000 of their net equity, and they reduced their debt by $40,000 at $260,000, and the replacement property was $700,000. So as you can see, they now have boot, mortgage boot, and cash boot combined of $140,000, and that is subject to capital gains taxes. So what is the 1031 exchange? How does it work? So the taxpayer is going to put their property on the market. They are going to get an offer accepted. Then you contact your qualified intermediary to get your paperwork set up, because the exchange documents need to be done prior to close of escrow. Okay, then you're going to close escrow on your property. Okay, the funds from the buyer are going to come over to the qualified intermediary. The reason for that is you are not allowed to have constructive or actual receipt of those funds for the 1031 exchange to work, which is why your exchange documents need to be done prior to close of escrow. When close of escrow occurs, then that's when your identification period starts. You'll have 45 days to identify your replacement property and 180 days to close on those. Normally, people use the 3 property rule. Basically, you're allowed to identify up to 3 properties, and you can close on 1, 2, or all 3 of them. There are other rules, what I would get into with you separately if you give me a call, if you have interest in that. So then once you close escrow, the funds come to us, we hold those, you go out, you find your replacement property, and when you're ready to close escrow on that end, the qualified intermediary forwards the funds to the seller, and then you are in possession of your new property. Can you do a multiple property exchange? Yes, you can. Again, you're going to sell that property. You have 45 days to identify your replacements. The funds come to us. We hold those funds. You've got your 3 properties that you're going to be investing in, or your 3 assets, and then we'll send those funds on to the seller of those properties for your 1031 exchange. Now, steps to take prior to the exchange. You always want to consult with your tax advisor. You want to make sure that there's enough capital gains for you to do a 1031 exchange, because if it's minimal or negligible, you may not want to put yourself inside of the box of a 1031 exchange, because you have to abide by all those rules with the 45 days and the 180 days identification period. Consult your qualified intermediary. So give me a call. Let's make sure we've got everything lined up so that we can get you ready for your exchange, and confirm who the taxpayer is. Check with your tax advisor. Make sure we understand who the taxpayer is. Okay, and a little bit about us again. API is a leading national qualified intermediary. We have facilitated over 200,000 exchanges. We are one of the largest QIs in the United States. We were established in 1990, so we've been around for over 30 years, and we are a member in good standing with the FEA. So I just want to thank Ryan again for having me here today to talk to you a little bit about 1031 exchanges. I'm happy to get on a phone call with any of you if you have further questions. And on that note, thank you, Ryan, for this time. I look forward to hearing more about the DSTs and sharing that information with our clients, because they are such an important vehicle for investors, either as their main investment or as a really good backup if they're worried that they're not going to be able to find something within those 45 days.
Yeah, thank you so much, Stephanie, for presenting all that information on the 1031. We recognize that today what's being presented from both Stephanie and myself, it's a lot like drinking from a fire hose. There are many on here today who are brand new to the 1031 exchange, and there are those of you here that have done several. And it seems as though every time we both speak to a client, there's new things that get unpacked to the investor, and we just want to be a resource for you all. You may have noticed within this webinar, you do have the ability to submit questions. We will have a question and answer time period at the conclusion of today's webinar, so please do take advantage of that. And in that, you can ask just a general question. You can direct it specifically to Stephanie or myself. We're happy to cover that together. So this is a disclosure page. Is just basically saying that we aren't going to be talking about any specific investments today. In the event that a Delaware statutory trust or other type of real estate syndication is appropriate for you to consider, at that time, we will work alongside of you here at JRW to help determine what your goals and needs are and whether or not there are any investments out there that are suitable for you. and we'll present them at that time, and it will always be accompanied by a private placement memorandum. So oftentimes we're engaging with investors at JRW in many different parts of their real estate investment cycle. And a lot of that corresponds with the stage of life that the investor is in. There are periods of time where we're looking to maximize or grow our wealth. And then there are times that we will strategically plan. And those planning periods happen throughout your lifetime. So it could be that we're preparing to send kids to college or planning to buy our first home. In the case of the avid real estate investor, many times it's preparing for legacy planning. How am I going to maximize the gift that I'm going to leave to my children, that I'm going to leave to other heirs or charities or whatever it may be? And that's most often when we're stepping in to help our investors with the 1031 exchange. At JRW Investments, really our whole passion is to help enable investors to be secure, free, and generous. And so in that, we will utilize the 1031 exchange as a way to solve a tax problem, and then transition them into something like a Delaware statutory trust vehicle that can provide the security that they need so that they can leave a legacy of generosity again to their family or to charities or whatever it may be that's important to them. And so Stephanie mentioned during her presentation that the biggest advantage that you have with the 1031 exchange is not paying that capital gains bill. Okay, not paying the state, not paying the Fed, not paying all this depreciation recapture penalty that you've utilized as such a blessing over the life of your ownership. And under current tax law, for most of you, in the event that you decide to hold on to your real estate, at your passing, you may be eligible for a step up in tax basis. And now, rather than giving the government, what could be half of the equity that you've built up in your property, you have the ability to give the whole thing to those whom you deem to give it to. Yeah. So what is the Delaware Statutory Trust? So the Delaware Trust is a concept that has been around since 2004. There was an official IRS revenue ruling. So we're 20 years in. Over the past 18 years that I've been in this industry, really Delaware trusts have become the more popular investment vehicle starting just after the Great Recession. But it essentially, what I want to talk to you about today is how do we demystify the DST? The DST is really just an ownership structure. It is a way that title can be held on real estate. It is a structure that holds real estate, and it might hold residential property. It might hold commercial property. There's a number of different types of assets that it can own. Many of you likely have revocable living trust set up, and that is a form of a grantor trust where you are currently both the trustee and the active beneficiary, and your trust doesn't file its own tax return. Your trust owns assets. It owns real estate. It takes title to a bank account. Okay. And as trustee, you are managing the trust and the assets within the trust for the benefit of the beneficiary. Now, in your living trust, it's very common that the contingent beneficiary upon your death might be your children, right? In the Delaware Statutory Trust, you are taking, as an investor, a beneficial interest in a trust. And the trustee is not you. The trustee is usually the sponsor company, a professional real estate group that is actively managing the real estate and actively managing the bank account. The reason why investors like to utilize this particular vehicle is because you can have hundreds and hundreds of investors all investing into one DST that may own a single property or a diversified basket of properties. And you can do so with typically as little as $100,000. Sometimes it's even lower than that. And so you can gain access to properties that you wouldn't be able to access otherwise. In these vehicles, it's often asked, oh, this seems like a REIT, a real estate investment trust. In some ways, maybe it can, because it is diversified and it allows an institutional manager to acquire the properties and manage them. But in a lot of ways, it's quite different. These programs are not blind pool investments. What does that mean? It means that the real estate already exists inside of the fund before you ever place a dollar into it or even look at the fund. So this is not something where you're going in and you're hoping that that company is going to acquire properties that might be suitable to you. We have the full ability to analyze everything that's inside of that fund from day one. This is property that's already stable. It's already cash flowing. Now, who is this vehicle appropriate for? It's appropriate for the investor that's looking to defer taxes. It's for the investor that's looking for cash flow. So these aren't development deals. Again, this is stabilized real estate where income is currently coming in from tenants. It's desired by investors who are seeking to transition away from active management to professional management. It's appropriate for the investor that's seeking to diversify, and that diversification can look differently for different investors. It might be that we're diversifying across several different asset types. It could be that we're diversifying across several different management companies. It could be that we're diversifying across several different areas of the United States. This is right for the investor who is in the middle of their retirement planning. Our average investor is 72 years old when they go into a DST. Now, just the other week, I completed an exchange with somebody that's in their young 40s. And that's very common too. But most commonly, it's the investor that's really seeking, again, for preparation for estate planning. How do I go into something that I can easily hand off to the next generation? Now, it is important to know, in order to be eligible to invest into a Delaware statutory trust, you must be an accredited investor. That means if you're an individual, your net worth, excluding your primary residence, is more than $1 million. And if you're if you don't qualify that way, you could potentially qualify by income. If you're single, that means you make over $200,000 a year in 2 out of the last 3 years, and you expect to make that ongoing. If you're married, it's a $300,000 threshold. If you're investing through some sort of entity meaning something like a limited partnership or corporate entity, in that vein, you must have a $5 million, not net worth, but $5 million worth of gross assets inside of that entity, or all of the investors related to that entity must be accredited by some other means, the income requirement or the net worth requirement. There are certain offerings where you do need to have third-party accreditation verification, and in others, you can sign a financial statement or provide a copy of your tax return, but that's something that we can review together. As Stephanie mentioned, the very first important step when you're considering a 1031 exchange is to determine whether or not you have a tax need. Okay, and so when investors are engaging with JRW, one of the very first exercises we do is we want to look at your particular tax basis, and we want to evaluate where you're coming from, and we can help do some what I call hand grenade math to figure out what a ballpark tax liability may be. And we're going to be one of the first people to tell you to not do a 1031 exchange if that's the right move. So we're happy to work alongside of you with that. And of course, we can help you evaluate apples to apples what your most recent property looks like compared to what the current market looks like across DSTs. Now, there are some challenges that exist within DSTs. The same risks are going to be present in DSTs that are present in traditional real estate. So if you bought these same types of assets on your own, you'd face the same challenges that you'd face in the DST. And that would include things like macroeconomic risk. Okay. Now, there are certain advantages that the DST may have to help mitigate those risks, be it the institutional level management or insurance policies that are in place, or the general nature of limited liability that exists within the structure. But in large part, it's going to feel very similar. How it's different is the curse of the blessing of being passive is that you're giving up control. You're trusting a third-party manager to act in your best interest and the best interest of all the investors. And so they're going to do everything they can to manage that asset effectively. However, as a result of that, they are the ones who are going to determine the exit. For you're the one that's determining your exit, and you're going to determine, is that at the right time or right price? For these sponsor companies, we typically find that their exits happen on average about 7 years. Now, there are some exits that happen sooner than that, and some that happen later. With these investments as well, you have to understand that there are costs that are involved. The sponsor is not allowed to share in the profits with investors. Okay, so that means all of the net income that's derived from the program, they need to distribute to investors, except for what they might hold back for deferred maintenance at the property. Okay, and at the end of the day, when they sell, any money that's held in that bank account belongs pro rata to the investors. Likewise, the net sales proceeds belong to the investors. However, these companies, so where do they make their money? They make their money really in two places and potentially a third. They make an acquisition fee, which is essentially their commission for putting the deal together. Okay. And then they're also making a property and asset management fee, and that's going to be based on the rents that they collect. Okay. And then lastly, they may be entitled to a disposition fee or a commission when they sell the real estate. Again, we can dive a lot deeper into this with future conversations if you're interested. But all of this to say is that when you give up control and you trust a third-party manager, we're really at the mercy of what price did they buy the asset at, and what price are they trying to sell it to you at, and what is their underwriting? What are they planning to do with that asset over the long term, and does that make sense? And then what is their exit strategy? How do they plan to exit accretively to get investors their money back or get appreciation? Now, the advantages of the DST, there are many. The other side to the curse of being hands-off is the blessing of being hands-off. And so that's, again, the typical reason why investors are coming to us looking for a Delaware statutory trust vehicle, is because they're sick of dealing with tenants, they're sick of dealing with their property manager, and they're simply looking to enjoy the lifestyle that they want to have in or near retirement. And so there is professional management. You have all the benefits that come from real estate. They flow through to the investor. We're looking at institutional quality assets. So typically we're not finding single family homes within these programs. These would be things like large Amazon distribution centers or 200 or 300 unit apartment complexes. So you're gaining access to assets that you likely wouldn't have access to otherwise. And because the investment minimums are so low, we talked about this before, you have the ability to diversify. We have the ability to customize the actual amount that you're investing into the exchange. If you were to work with asset preservation and look at local property again, the chances of you finding a property that's priced to the penny of what it is that you're coming out of from your sales proceeds, that likelihood is probably pretty small. In a Delaware trust, we can take investments to the penny. So we can perfectly match the exchange equation that Stephanie discussed earlier. And by the way, if there is debt in a DST program, that debt is non-recourse financing to the investor, meaning if there were ever a default, okay, or a foreclosure, no one can, the lender cannot come after you or your personal assets. And in the same way, these vehicles provide a natural limited liability protection inherent to the structure so that each separate investment is insulated from from litigation, and so only the equity that you invest would be subject to risk there. These investments are really easy to retitle or split fractionally. It's very common that I have investors who come to me and say, Ryan, I've got a couple of kids and they want nothing to do with real estate, or one of them does and one of them doesn't. And so they want to utilize the DST as a way to prevent fighting amongst their kids. When they sell, it's very easy for us to follow the estate plan and divvy it up. So Johnny gets 50% and Susie gets 50%. They're in that vehicle until the real estate is sold. And the point that it's sold, that then allows each of them to go their own separate ways. The other thing that exists, and I'd say right now there are 7 different companies, sponsor groups, these institutional managers that have active REITs. And by active REITs, I mean active publicly reporting REITs, where their intention is to have a strategic exit. Their REIT would buy the properties from the Delaware Statutory Trust. And at that time, it could allow investors to move from the DST vehicle into a REIT operating partnership where you have even more diversification. You maintain your tax deferral status, and you're now in a position where you're in a much more liquid vehicle. You can sell your positions over time and use that as a way to harvest your gains to offset losses. You can use it as a way to stay in lower tax brackets at the state and federal level, or you can continue to hold on and have it qualify for step up in basis at death, and then have your estate sell it right away, again, rather than in the DST where you're waiting for the sponsor to sell. Now, across DSTs, I mentioned that you have access to many different asset classes. Most commonly, we're engaging with apartments and industrial property and retail or office triple net. But we also very regularly see things like student housing, self-storage, hospitality hotels. We'll see oil and gas occasionally. There's many, many different types of industries, but usually about 75% is either some form of triple net asset or apartment. Now, when you buy properties in the commercial sector, you're buying that piece of traditional real estate. You're buying a 300 unit multifamily. You're buying a net lease property, and you're doing so as the sole owner, or you might be engaging with other partners in a partnership structure or a tenant in common structure. In the DST, you're buying those exact same assets. You're just doing it with the wrapper over top of it. Okay, so it's the same property, potentially same location, but you've got this wrapper that allows you to be hands-off. The other difference is that your dollar can stretch a lot further. It's very common that you might be able to buy multiple DSTs or invest into DSTs that contain multiple properties. So now your $1 million, instead of it just buying you one triple net asset, you might be able to deploy that $1 million and invest across apartments and self-storage and triple net assets, and have many, many different tenants in many different areas that are collateralizing your capital. As I mentioned earlier, every investor needs to have a fundamental understanding of how these deals are made. It's not just as simple saying, okay, it's passive and I've got an institutional company that's managing everything. What it really comes down to, if we were to narrow it to 3 categories, is one, you need to understand the price that you're paying for that asset or group of assets relative to what they'd trade for outside of a DST structure. We need to understand what it is that the sponsor is looking to do with that asset, and how does that compare with what the rest of the market is doing with comparable asset classes. So we want to see real comps. And then we want to see what is it that they're doing as far as exit. What is their plan, and how is that going to add value for investors? Now, that's boiled down to 3 categories. At JRW, we're looking at well over 200 different data points within any particular offering when we're deciding whether or not it's something that we would approve or not. Now, I mentioned the sponsor companies. So currently in 2024, there have been 54 different companies that have put together DST programs this year. And some of these, I could only fit so many on this slide deck, but some of these names may be familiar to you. Our goal at JRW is to have access to every single DST program that comes out from each of those 54 different companies. Today, there are only 50 companies that have currently active programs that are accepting equity. So we want to review them all. And right now, there are 90 investments in the market. That number changes daily, right? Because the sponsors are only accepting a fixed amount of capital. And once they raise that capital, they're not looking for more investors to come in. They're just going to manage that. And so what we want to do, again, is we want to have access to the full gamut of what's out there. Now, about 100% of the investments we review, okay, they're going to at least go through a 2 to 4 hour initial review process. And during that review process, we're looking at very high level things, okay? So we're going to look at the manager and their track record. We're going to look at the price they paid. We're going to run comp studies. We're going to look at environmental reports, and we're going to look at property condition reports. We're going to look at the tax opinion on the investment. And we want to make sure all of those things are in good order. Following that, we're going to go through a full financial review process, which usually takes about 20 hours. It's really, really paramount that these programs go through something like that. We have a due diligence committee of 6 where it's their job to do this review. And if any of you are interested, I welcome you to schedule a meeting with me and one of our analysts where we can walk you through what that process looks like at length. But generally, only about 15% of investments survive that 20+ hour review process. From there, if they survive, that's when, if it's a, say, apartment asset, we're sending one of our analysts out to actually walk the property, to interview the property management team, to get a feeling for exactly where that property is located geographically, to talk to the maintenance team. There's a number of things that we do. And then there we go back to the sponsor with our laundry list of questions to get those answers. So all of that happens relatively quickly when an investment comes out, but we're all hands on deck in our due diligence team to really understand those programs. Historically, only about 5% of what we review has become a suitable recommendation to our client. So all of that's going on behind the scenes. My job and the job of the other advisors at JRW is to really, again, understand your situation, your timing, your goals, your needs, help you understand the market. And then we're going to be looking at investments together, hopefully within the weeks prior to close. So about the same time that you'd engage with Stephanie to set up an intermediary account, it's at that same time where we're going to look at actual investments. And that will always be built upon a foundation of you also understanding our the economic situation that we're in and what our buy box is. So what is our current acquisition criteria? What are we looking for in light of your goals and needs and in light of what we're seeing happen economically? Now, again, I mentioned that we have a pretty lengthy review process. This is not intended for you to be able to interpret with a magnifying glass what's here. If this spreadsheet goes on and on and on, but it gives us a side-by-side comparison view of every particular investment that's in the market. So now I want to open it up for a question and answer time. Again, we do have the Q&A set up on on this where you can ask your questions. And so I will be reading these off. Please feel free to ask as many as you can. We've got about 15 minutes till the top of the hour, and Stephanie and I will try to get through these. Additionally, at the point that you exit this webinar, there will be a survey, and we do ask that you go ahead and fill that out. It's only a few very simple questions, so please take the time to do that. That's very helpful on our end to know whether or not we should be getting in touch with you after this. So the first question that we have is, will a recording of this presentation be recorded? And the answer to that is no. This is not going to be recorded. So we do have these presentations on a recurring basis. You are always welcome to set up a one-on-one meeting with myself or Stephanie or the two of us together, and we're happy to apply all of this information to your specific situation. I'm going to read this question and then determine who to direct it to. If you are selling multiple properties, say 3 in an exchange, in order to purchase one large property, does the first 45-day timeline start when the first property is sold? Or are there 3 separate 45-day timelines? How does that work? Stephanie, would you like to answer that?
Yeah. Hi. So, yeah, if you're selling multiple properties, your 45 days begins at the close of escrow on the first property, if you're going to be putting them all into one. So again, if you're selling multiple properties, you want to kind of get with your real estate agent and see if you can maybe put some options to extend into that. So you make sure that you've got a longer period for identification, and to make sure that all of the properties actually do get sold and close escrow within that 45 days. So yeah, that's the best thing to do is try and work with your real estate agent, to make sure you can get that 45 days pushed back to starting as close to having all 3 of them sold as you can.
Yeah, thank you, Stephanie. And that's a common question that we get for investors that are looking to scale up. I was working with an investor just yesterday, and they have a large portfolio of properties, and they're looking at DSTs. And they asked, do I need to sell them all at the same time? No, you don't. You can potentially combine those sales into one exchange account, but you, in a lot of ways, run into the same issue that Stephanie was just discussing. If we're looking at DSTs, it's typically more advisable to sell at the right time for the best price, and then we can deploy the capital into DSTs over time, and that allows you to effectively dollar cost average or to enhance your diversification. Another question here. Are DST investments typically only in big round numbers, such as 50,000 or 100,000? What happens if the cash from my exchange is not a round number, 121,000? Yes, DSTs can be invested to the penny. Typically, the minimum might be a round number, might be 50,000 or 100,000, but typically any number over and above that we can customize to the penny. What percentage of the DSTs that you offer are debt-free? I'm going to rephrase that question. What percentage of offerings in the market today are debt-free? Right now, that number is around 40% of DSTs are debt-free investments that we're reviewing. And that's primarily a function of the current debt market. Right now, interest rates are a lot higher than they were a few years ago. From, let's say, 2016 to 2022, I would say that it was closer to 80%, 90% of investments in the DST space had debt on them. So today it's a lot fewer. All right. Stephanie, this is a question for you. How early does a qualified intermediary need to be hired prior to selling the subject property for a 1031?
So, I mean, technically, we can be hired the day before you close escrow and get those exchange documents out to you immediately. But I prefer to start working with my clients right around the time that they're going to go on the market so that we can have everything all set up, answer any questions, make sure we understand the exchange entity, make sure that they've circled with their CPA and that they need to do a 1031 exchange. Typically, we get a lot of people coming in when they open escrow or just before they're about to open escrow. I like to get everything set up as soon as escrow is opened on that sale. So I would reach out to your escrow officer the minute escrow is opened. I'm going to get your purchase and sale agreement as well as title, make sure everything lines up properly, and then we'll get your exchange documents out to you again, because exchange documents need to be done prior to close of escrow to avoid you having any constructive or actual receipt of those funds.
Yeah. Great. Question, I'll take it. As an industry standard, what is the range of sponsor fees and how do you recommend vetting a particular sponsor? So every investment comes with something called a private placement memorandum. And that is where every bit of the structure is exposed to investors and to advisors. And so we can see a breakdown of the sponsor's actual fees, what they're charging. We can look at their track record and see how they performed on previous programs. The fees, to give you an average range, usually an upfront acquisition fee is going to fall between 1% and 3% of what's going in. on an ongoing basis for property management, it's usually going to be the more active management that's involved, the higher the fee. Okay, and obviously the inverse is true. I would say that the typical range is somewhere between 2 and 4% of rents would be taken in an asset management or property management fee, which if you're coming from residential space, most residential investors are paying somewhere between 8 and 10% in property management fees on their rent. If it's an Airbnb situation, that might be as high as 20 to 30%. So we find that it's very competitive, and if not a cost saver, it's because of economies of scale. These are just really, really big funds. As far as the vetting goes, we do background checks on sponsors. Again, we look at their track record. For us, as it relates to fees and it relates to the sponsor company, we're going to make sure that anything that we're recommending is not with a sponsor that we have lost trust in. Okay. We've been in this industry since the inception, really, and we've seen a lot there. For us, when we're looking at these programs, it's real estate at the end of the day. And because it's real estate, what we want to look at is the total price you're paying, right? So why is that important? Well, you might have a sponsor that's touting low fees, okay, that maybe says a 1% acquisition fee. But if they overpaid for the property by 20% more than it's actually worth, that low fee doesn't really mean anything, right? You might have a sponsor that buys a property at a deep discount to market. And if they're taking the higher end of fees, well, if they're still passing along that discount to you as an investor, that's going to be what's important. So we want to know, will that real estate sell for at or higher than what you're paying to get in? That's the most important piece of it all. As far as costs involved with working with JRW, we function in the same way that a real estate broker would, representing you on the buy side. So we get a commission paid by the seller one time. There are no ongoing management fees that are taken by our firm, but we will continue to walk alongside of you for the life of the investment. Now, this is more of a specialized question, and Stephanie, you can let us know if it's one that you'd rather take offline. It says, are there any pre-sale strategies to transition out of a general partnership position to individual ownership? And so what I believe he's referring to is what's often referred to as drop and swap. I'll let you speak to that if you'd like to.
So yeah, that does sound like what he's asking about is the drop and swap. So you would want to do that as far out from the sale of your property as possible. You also want to get together with a tax attorney so that they make sure that that's done correctly, especially if your property is in California, because they really are scrutinizing those drop and swaps very closely. And when you do that drop and swap, or move out of a general partnership into individual ownership, you want to make sure that you're doing everything possible to show that this is being done correctly, such as changing insurance and making sure that everything's lined up where you have a certain amount as a tenant in common type position as the other person does. But again, you want to circle with a tax attorney and a CPA and make sure that everything is done correctly. And again, the further away from the sale that you do it, the better for you.
And we're happy to refer you to law firms that specialize in drop and swap and drops. It's something that's very common and can be handled appropriately, but it's, again, really beyond the scope of what we're doing at JRW and what asset preservation is doing. We're definitely able to work with you in those situations, but as Stephanie mentioned, you really need to work with your own CPA and attorney to understand the potential ramification or risk of doing that. This is a question for Stephanie. Stephanie, what is the cost for doing a 1031 exchange transaction with asset preservation?
So with asset preservation in California and most of the United States, for a regular delayed exchange, it includes the sale of one property and the purchase of up to 3. We charge $1,250.
Great. And we find that to be one of the most competitive prices in the industry, especially if you're doing multiple purchases of individual properties or DSTs or a combination. We typically find that most groups out there, their fees get up to about $2,000 if you're looking to make up to 3 purchases. So this is one of the reasons why we really enjoy working with asset preservation is they save our clients money. They have a great set of teams both on the East Coast and on the West Coast, and they really do a great job in managing the entire exchange process. So great value there. Ryan, you mentioned the equity portion is at risk. Can you elaborate on this, please? So what I was referring to there was talking through both the limited liability protection and the non-recourse financing aspect of a Delaware statutory trust. So let's say, for example, that you invest into real estate on your own and you invest in your own personal name, okay? If you have a loan and you default on your loan, the lender has full recourse to come after not only your asset, but you personally to satisfy that loan, okay, that you owe them for. In the same way, in the event you own in your personal name and somebody dies at your property, gets injured, and they come after you, they take the property, you can be personally liable beyond just the property value. In the case of a Delaware trust, your maximum liability is the equity that you invested into the program. It's very similar, somewhat different, but very similar from a limited liability standpoint, is if you own one of your rental properties in an LLC today, your exposure is limited to what you own inside of that one LLC. So it's very common that we have investors that, and this isn't me providing legal advice to you, but it's very common that we have clients that own a portfolio of properties and they have separate LLCs to insulate each portion from one another so that they don't lose the whole portfolio. With a DST, if there was litigation or default or anything like that on a loan, the maximum that you could lose is the equity that you have invested. If you need more clarity on that, I'm happy to meet with you offline and we can discuss that further. It's really the whole reason why we do the due diligence and re-underwriting that we do is for our investors to not understand the benefits that exist within the program, but really where the cracks lie and what does a downside case scenario look like and what does it maybe take, what levers have to be pulled to potentially get to that point. Question here, how long is the average hold period in most of the DSTs that JRW recommends? Really, as far as the recommendation goes, that's always investor specific and market timing specific. Right now, it's very common that we're recommending programs that have an average hold period of 3 to 5 or 4 to 6 years. And that would maybe be appropriate for the investor that's either looking to do a 721 exchange strategy or someone that's looking to utilize a DST as a way to bridge the current economic cycle and then re-engage real estate in the nearer term. But it's also common. We have programs on our platform today that are probably going to be a 7 to 10 year hold. Typically, they don't go beyond 10 years. Let's see, we've got one more question here, and I'm not quite sure I understand. Stephanie, I'll let you take a stab at it. It says, if you have a trust that has been liquidated and my share is held in an escrow account, can I still do a 1031 exchange if I have not taken any funds from the escrow account?
Yeah, so Kathleen, I would really appreciate it if you would give me a call or send me an email about that because I want to make sure I understand the question better. So I look forward to hopefully speaking with you or emailing with you shortly and helping you figure out if you qualify for a 1031 exchange or not.
Yeah, great. It looks like one more question came in here at the top of the hour. This will be the last one I answer here. If you have a question that you feel wasn't adequately answered, or you'd like to, you have additional questions in the question and answer, you can specifically list out that and Stephanie or myself will get in touch with you. We'll also have the ability there for you to mark down whether or not you need any immediate assistance or you'd like to have a phone call with us. We're happy to schedule a time to meet with you both. On this slide, hopefully too, you've seen our contact information where you can send us an email or give us a call directly. The last question is for me. What is the approximate commission percentage charged by JRW to an investor? So going back to the DST and how it's set up, when the sponsor puts a program together, they're going to outline all of the costs that were associated with them buying and reviewing or conducting a due diligence on the property. So whatever they may have paid for a third-party appraisal or property condition report or environmental study, what they paid their attorneys and as far as fees goes, what did it cost them to syndicate the investment and put the DST wrapper over it, what compensation is going to them. And they'll also outline what the commission is that's going to the broker. And so it's always programs specific and sponsors specific. Again, you can look at JRW as essentially the one that is brokering both sides of the transaction. Okay, we're representing you as the buyer, but we're also representing the sponsor as the seller. So typically we find that the commission that the sponsor would like to pay us somewhere between 4 and 6% on equity for both sides of the transaction. So if there is debt involved, usually that becomes a smaller amount. Now, again, at the end of the day, so you're going to experience the same thing when you sell your real estate. As a seller, you're going to pay both the buyer's agent and the seller's agent. Now, I know that's changed a little bit here recently with realtors, but that's how it's been traditionally, and it works in the same sort of manner here. As you buy property, if you were to buy an individual asset, the same thing is happening, but you're not really feeling that commission being paid. It's the seller who's the one that's dishing out those dollars. And so again, what you need to be conscientious of, whether it's a DST investment or it's you buying a local asset, is are you buying that property at a fair price? And whoever's representing you, are they doing an adequate job in helping you understand what it is that you're buying? Okay. And so that's the value that we're going to provide to you, is making sure that you're investing into programs that really make sense and that we're avoiding the ones that we should be avoiding. So that was no other questions have come in, but again, we appreciate you guys and your time today. Stephanie, thank you so much for joining us today and being a part of this. We look forward to having you with us once again. And please don't forget about the survey here at the end of the presentation.
Thank you, Ryan. Thanks everyone for tuning in and learning a little bit more about DSTs and 1031 exchanges.
Thanks so much. Bye-bye.